All right, day six, section four. Let's talk about innovations in US banking. So, in the previous section of today's lecture, we talked about the history of US banking and kind of this unusual history that banks were very small and decentralized and kept purposely weak because of our kind of cultural and social fear of centralized banking and centralized power in the US. However, banks have innovated and are evolving quite dramatically. And a lot of this is due to financial innovation, right? Finance has evolved in different ways, forcing banks to evolve in different ways. And so I want to talk about a number of the innovations that have changed banking here over the last couple of decades. Some of these are quite obvious, right? Things that you're well familiar with and won't require much discussion from us. Other things are probably things you're not as familiar with. And so we'll have to spend a little bit more time talking about these things and making sure that we kind of understand the basics. So let's talk about innovations in US banking, right? And here I think I have, just to prepare yourself, about a dozen things that we want to talk about that have changed US banking here over the last 20 years. First off, credit cards, right? It seems obvious, but credit cards have offered banks an opportunity to get much higher returns than was possible before credit cards, but of course with much higher risk. Credit cards are really a function of information technology, right? I mean, we had credit cards before computers, but if you've ever seen the old-fashioned credit card receipts where you actually had to take a piece of paper, put the card on it, and it had a what do you call that thing? Like you basically put it in this machine and you run it across your card, and it made like an imprint of your card. And that's what you kind of use, and you had to send it then physically to the bank. And it was very complex and not particularly efficient business. Really, credit cards weren't widely available to many Americans and to many retailers until information technology. And so has been a huge part of bank business over the last 20 years, is generating much higher returns than banks ever before were able to get, but of course more risk. And that's going to be a theme of a lot of these innovations, is that banks are more profitable now, but they're probably also more, they're not probably, they're definitely more risky than they were 20 or 30 years ago. Electronic banking, right, and financial tech, things like peer-to-peer lending or Venmo. Listen, this is competition for banks, right? Banks are getting more competition from electronic banking. Of course, banks also then are getting benefits from this, right? One of the things that I put on your handout list is this article on banks in your pocket, right? For you, people of your generation, young people on their phones are shaking up banking because you're much more likely to do your banking on your phone, right? And to even do borrowing and lending, not just deposits and transferring money on your phone. And so this article really kind of talks about the ways that electronic banking is changing. And we've talked about this before, but really the U.S. is behind on this. If you go to China, I think I've talked about my trip to China in December. I mean, I was kind of blown away at just how common mobile money is. It really has become more common. It has become the most common source of money, right? I mean, most transactions now are taking place electronically. And so this creates opportunities for banks, right, to get involved in certain activities that maybe they weren't able to in the past. But then it also creates competition for banks, right? Because banks aren't just the only institutions now that can create payments, right? You have places like here in the U.S. Venmo that actually can create a real source of competition for banks when it comes to managing payments. All right, the third financial innovation, once again, something that is both a source of funds and a competition for banks, is commercial paper. Banks can borrow in bond markets, but banks also have to compete with bond markets, in the sense that many firms nowadays, instead of going to a bank for a loan, will just go to commercial paper markets or other bond markets. And so, once again, this is something that banks benefit from, but it also has created a big source of competition for banks that didn't used to be there. Likewise, junk bonds, right? Remember, junk bonds are these higher risk bonds that are offered by smaller and newer corporations. 20 or 30 years ago, when the junk bond market was not developed, these kind of firms only could borrow from banks. Nowadays, the junk bond market is actually quite a popular way for newer firms to borrow. Um, if you're interested in the story of the junk bond market, you might be interested in reading about Michael Milken and Drexel Lambert. It's actually a very interesting story. Milken is kind of in many ways the father of the junk bond market. And so had kind of a high flying career at a investment bank by the name of Drexel Lambert. Eventually, he was convicted of security fraud. Drexel Lambert went out of business. He was sent to jail. And recently he was pardoned by Donald Trump. And so he's out of jail now. It's the whole story of Michael Milken is kind of one of these rags to riches stories. And have you ever seen the movie Wall Street with Michael Douglas? Basically, Michael Douglas's character was kind of built upon Michael Milken. And so it's a kind of an interesting story about, once again, kind of the rise and fall of the Wall Street Titan. And so junk bonds in many ways really kind of capture many of the great things about Wall Street, right? This ability to innovate and to create new sources of funds that can fuel entrepreneurship. And then it's also the downside of Wall Street, right? This kind of excessive risk-taking, moral hazard behavior, and oftentimes bending the rules for your own self-interest. We've talked about money market mutual funds, right? These are funds, mutual funds, right, in which investors can buy a share of the fund, basically a $1 share of the fund. And it gives you access to holding a big portfolio of safe securities, such as commercial paper. These things are offered through banks, and you can usually write checks on them. So I have a money market mutual fund. I think I have the ability to write 10 checks a month on them. You can't write more than that. But they're appealing, and one of the reasons they're appealing is that they offer you a little bit of interest in the money that you hold. We won't talk about the crisis of 2008 much here, but I'll say that one of the things that really facilitated the crisis is that for a short period of time, these shares that people had bought for $1 were actually selling for less than $1. And that was referred to as breaking the buck. And it was one of the things that led to a lot of short-term panic in bond markets, right? Is that the worry that these money market mutual funds were really in danger, and to put a lot of savers' money at risk. The Fed eventually helped bail these money market mutual funds out. Paying attention to these money market mutual funds has been one of the things that the Fed has been spending a lot of time paying attention to during this pandemic. The Fed does not want this to happen again because because so many small savers are invested in this. It's exactly the kind of crisis that could trigger a bigger banking crisis, and people pulling a lot of money out of the financial system and undermining not just banks, but bond markets, stock markets, whatever, right? Trigger a bigger financial crisis. So the Fed has been paying very, very close attention to these money market mutual funds. Securitization, right? We've talked about this before, the securitization meaning transferring unique and illiquid assets into standardized and liquid assets, right? This is what mortgage-backed securities are. Mortgage-backed securities took unique and illiquid mortgages and turned them into standardized bonds that were much more attractive to savers. And better information technology allowed this. Also, the federal government has played a big role in securitization through Ginnie Mae and Fannie Mae, right? These are two government organizations that in many ways they've provided insurance on these mortgages to basically reduce to almost zero the default risk that many of these mortgages have, make them much more appealing for investment banks to buy and then turn into bonds. The Ginnie Mae and Fannie Mae have also played a role in standardizing mortgages, right? Making sure the contracts on mortgages look more and more the same, so that there's very, very little difference in terms of like the actual technical legal language. And so, Ginnie Mae and Fannie Mae have made it easier to get a mortgage, but as we will talk about more as we go along, um, sometimes you can have too much of a good thing. And that's exactly what happened in 2008, when Ginnie Mae and Fannie Mae basically began to insure mortgages that had no right to be issued in the first place. And this fueled the mortgage-backed security bubble that eventually popped and undermined the security of the whole financial system. Today, though, I keep on talking about mortgage-backed securities, but basically any sort of asset that is unique and liquid can be turned into a bond through the securitization process. David Bowie, before he died, basically, I wish I could remember the number, but it's something like he raised over $300 million by securitizing his song catalog, right? So basically, he sold his song catalog, and for $300 million, and so the royalties that he gets off his songs will pay for the bonds that were issued to pay David Bowie, right? So he basically was able to cash in through this process of securitization. And so, car loans can be securitized, commercial loans can be securitized. Any sort of loan, any sort of asset, in theory, can be securitized if there's interest in it. Financial derivatives. All right, we'll have more to say about this a little bit later, but let's just talk in brief about how financial derivatives have changed banking. A financial derivative is an asset whose value is derived from another asset, right? So you could think about a mortgage-backed security as a kind of financial derivative, but there's other sorts of financial derivatives out there. A very popular kind of financial derivative is what's called a credit default swap, right? And a credit default swap is basically is a bet, right? You enter into a contract with somebody that says, for instance, if General Motors fails, you have to pay me $10,000. Now, that swap could be a way of reducing risk, right? Like, for instance, if I hold some bonds of General Motors, then I could buy one of these default swaps, so that if General Motors defaults on my bond, I'll still get paid, right? In that case, I'm reducing my risk. But what happens if I don't hold any General Motors bonds? In that sense, I'm actually increasing my risk, and I'm betting and kind of hoping that General Motors does fail, right? And that's the thing about these financial derivatives. Their value is derived from another asset. They can be ways of reducing risk for certain investors, but they can also be ways of increasing risk for other investors. Futures are the same, right? So if you enter into a future contract, right? For instance, if you say, I, in the future, agree to buy corn at this price, right? That's a derivative. And that could be a way of protecting me from risk if I think I'm going to have some corn that I need to sell, or I'm going to need to buy in the future, or it can be a way to speculate, right? So financial derivatives can be extremely complex, right? And that is an understatement, right? That is an understatement. As banks have gotten involved in this financial derivative business, banks have found ways of making much bigger profits, but also exposing themselves to risk that is very, very difficult to understand. Just to give you one example of this is really almost an example that doesn't really help because it's so complex, but just to kind of give you a little something to think about here. Here's a little visual on what we could think of as modern finance, right? So this is the recipe for how a subprime mortgage can become a multi-billion-dollar mess. You could take a subprime mortgage, right? This is really impossible to read up here on the computer. I apologize. But you could, from that, take the mortgage and you could make mortgage-backed securities, right? You could turn it and put to credit card default swaps. You could securitize loans, student loans, credit debt. You could then break these into different tranches. A tranche is basically a different risk level. So you could take the riskiest of these loans and issue very risky, higher return bonds. And you could take the safest of these loans and issue very low return bonds. You can then also derive a number of other financial derivatives from these, such as these are called CDOs. Honestly, I'm not even going to get into some of this stuff because it's so complicated. What I'm basically trying to say is financial derivatives allow you to take a small number of assets and kind of essentially magnify it into an incredibly diverse and almost incomprehensible number of other assets, right? So you could take a mortgage that was maybe $1 million and to turn it into tens of $1 million of financial derivatives, right? A credit default swaps and futures and you know, yeah, I'm not even going to get into it, but basically this has become extremely, or can become extremely, extremely complex, offering banks an opportunity to make a real killing, but also exposing banks to the kind of risk that old school banks never faced, right? One of the ways that banks increasingly, at least bigger banks, are finding to kind of hide risk is through what's called shadow banking. Shadow banking is when banks are involved in lending through financial markets. So banks become more directly invested in, for instance, the stock market. Banks are not allowed to directly invest in the stock market, but they figured out ways to invest through shadow banking, right? And what are called SIVs, structured investment vehicles. Okay, this is a little complicated, but I'm going to do my best to explain how this works. Let's begin with a bank, right? Just a regular old bank. We'll call this the Big But Simple Bank, right? BBSB. This bank has $100 billion of loans and $90 of deposits and $10 billion in equity. And what is its leverage? Its leverage, which is its assets divided by equity, is 10, right? Its leverage is 10. So this is a relatively safe bank, but it's a boring bank and it's not making a ton of profit. So what could this bank do? It could create a structured investment vehicle, meaning a separate bank, a shadow bank, with $1 billion in equity from the bank. So we take one of these billions in equity and we start a new bank. Here's the balance sheet of my new bank. We have 1 billion equity. Where did this equity come from? From BBSB, from the Big But Simple Bank. Then this new bank issues commercial paper and raises another 49 billion. Okay, it takes this 50 billion and it makes loans. And these can be the riskiest, most toxic kind of loans possible, right? High risk, high kind of reward stuff. So this is the structured investment vehicle. This is the shadow bank. And this is what happened to the balance sheet of BBSB. It looks almost the same. The only difference now is that its loans, instead of being 100 billion, are 99 billion, and it has some stock in the structured investment vehicle. What's the leverage of BBSB? Well, notice that the leverage hasn't changed. It's still 10, right? So BBSB, if you just look at leverage, appears to be no riskier than it was before. But in reality, if you added the balance sheet, if you add this balance sheet of the SIV to the balance sheet of Big But Simple Bank, this is what their consolidated bank balance sheet looks like. And notice, in reality, the leverage is 14.9, right? 149 divided by 10. So in other words, the true leverage is almost 15, but if I just look at the balance sheet of BBSB, it looks like it's only 10. The bank has hidden leverage here, and it's impossible for most investors to try to figure this out. Banks are very good at hiding risk and making their leverage look lower than it is. And, this is to me, this is a very worrisome thing, right? Because when you can't trust information in finance, it's scary, because information is the key input in the finance, right? We know this from asymmetric information. So this is an example of how banks have developed many different ways of hiding risk and basically making the information that's available to public shareholders, to the public, much less trustworthy. And so I view this as one of the very dangerous developments in banking. Likewise, a lot of banks have gotten much more involved in what we call off-balance sheet activities. These are activities that don't show up on a bank's balance sheet, right? Because the banks don't really take a long-term asset position. They're more short-term activities that can still expose a bank to a lot of risk. So for instance, banks oftentimes sell mortgages, right? They'll issue a mortgage and turn around and sell it. That's not going to show up on a bank's balance sheet, but it did expose the bank to some risk. One of the biggest sources of risk here are trading activities. Banks oftentimes will be involved in trading activities, whether it's for financial derivatives that they'll be trading in, or for helping facilitate trades that they take fees, or trading in foreign exchange, right? Trading foreign currencies. And because these trades are very short term, like maybe a day or two, if you just look at the balance sheet at the end of the year, you'll never see these things, right? It's impossible to figure out how much risk is associated, because the bank doesn't often take a position for a very long period of time. But many banks have lost tons of money when they've made very bad trades, right? Trades that from the outside were impossible to see. Just a couple of quick stories about this. Nick Leeson, right, who is a famous trader for Barings Bank. Barings Bank was one of the oldest banks in Britain. He made a bet on the yen before the Kobe earthquake and lost $1.3 billion for Barings Bank. He ended up going on the lam and hiding out in Singapore for a while. Barings went bust because of the bad trades that this one trader alone made, right? One individual brought down what was, I think, the fourth oldest bank in Britain. Toshidi Iguchi and Daiwa Bank, right? Daiwa Bank, you don't know about it because it no longer operates in the US. This one trader lost $1.1 billion, and Daiwa was tossed out of the US for failing to disclose the loss. Yasu Hamanaka and Sumitomo Corporation, a single trader lost $2.6 billion by himself. But the king of this was Jerome Curival, who worked for Societe Generale, who is the biggest bank in France. He lost $7 billion, right, in a crazy trade that he got involved in. In fact, if you want to look at your handouts, there's actually a little article here. There's Jerome not looking very happy about being caught. But yeah, this one rogue trader by himself lost the bank about $7 billion, right? A huge amount. And so it just goes to show you that, there's a lot of risk in these banks that you just simply can't see from bank balance sheets. And this is increasingly true. So in many ways, banks are more profitable than they've ever been before, because they're diversified and they're engaged in a lot of innovative and very useful, productive, and profitable activities. but it has also exposed banks to a lot more risk than they've ever been involved in before. And a lot of this risk is just simply impossible for people outside of the bank to evaluate. And so that's the risk, right? That nobody really knows how risky most banks are. And so, when you get in a time like we are in currently, where banks are exposed to this big shock associated with the pandemic, um, how are banks going to stand up to this? Who knows, right? Who knows? Because a lot of us don't really understand what banks are doing. 20 or 30 years ago, when banking was much more simple, yeah, it was a lot easier to understand the risk associated with a bank by looking at its balance sheet. But that's not true so much today. All right, that's the end of section 4. We'll come back for one more section after a moment.